Hi everyone, this is part 11 of my Rivian deep dive. We finished part 10 discussing kind of high level the context of the operating profit with respect to investors over sort of the next 18 months. But now we need to look at, okay, what is actually driving this significant gap between gross profit and operating profit. So first, let's look at it on a combined basis. Combined basis means including all the operating items. So this is the total operating expense. So just to recap, in 2024, Rivian spent 3.5 billion in operating expenses, and you can see Rivian actually brought them down. You can see a significant year-on-year decrease in the third quarter, and then another one in the fourth quarter. So, and you can see down here, the forecast expects for 2025 just under 3.4 billion, which would imply a 3.3% year-on-year reduction in 2025. And here's a very important point. Rivian told us that they expect an increase in both R&D and SG&A expenses in 2025. So some underlying increase. So this means increase, but we are showing here a decrease. So the reason why I assume a slight decrease is, I think I'm in line with the R&D guys. This is likely going up because of the VW expense that's being reflected in that line item. But I think the SG&A part of the business has a significant, let's call it underutilization of existing capacity, and therefore I don't think there is a huge kind of investment need. I think RJ really set is to kind of make the case he's investing in the business and building for the future, that kind of thing. But in reality, he knows now he doesn't need to invest this year because volume isn't growing before there are more models, etc. So I'm more aggressive than what RJ tells us here. I think he's sandbagging here a little bit, and that's why I expected SG&A to be not growing very much at all. I do expect some R&D spend growth, but that's driven by VW JV. So on this slide, we now look at the R&D expense. So this is one of the main two components of operating expenses. And you can see that in 2024, Rivian spent 1.6 billion on R&D. The forecast reflects some very modest growth year on year of 4%, which is barely above inflation probably, and so it's kind of flat almost in real terms, even though Rivian is now expensing R&D expenses from the VW JV, plus obviously has to finalize design, not finalize design, but has to basically create all the designs has to finish development of the R2 platform, which means have to turn the prototypes into something that can actually be manufactured on a larger scale, plus also all the tooling that is involved with that, etc. So this is, I mean, if they can keep R&D at only plus 4% in 2025, this would already be quite amazing, to be honest with you. And so this is also in line with what they said. They expect some sequential, year-on-year increase in R&D expense. And then when we look at the SG&A expense, as I said earlier, I'm deviating here from management guidance. I'm expecting actually meaningful decrease of slightly over 9% year-on-year. So in 2024, Rivian spent almost 1.9 billion on SG&A. I expect this number to come down to just a tad over 1.7 billion, i.e. 9.2% year-on-year decrease, as mentioned. Then in 2026, I expect that number to kind of reverse again, but this is driven by obviously the R2 launch, because in the beginning of the R2 ramp, there will obviously be more selling activities. Also, the incremental volume has an effect on SG&A. So there is some direct relationship between SG&A spend and volume. But overall, this SG&A assumption in this forecast is very aggressive, because even in 2027, when the forecast expects volume to go through the roof, I expect some very modest SG&A increase of just under 5% for total SG&A of just over 1.9 billion. So if Rivian could deliver kind of this SG&A level, it would be quite amazing. And again, this is this is in conflict with what Rivian guided for in this line item. So this is again shows you the optimism of this forecast. So here on this slide, it provides you a relative perspective of how these two cost drivers develop, and a typical way that's often used in the industry to look at these numbers is by using what's often called efficiency ratios. So what you do is you simply put R&D expense or SG&A expense in relation to total revenue, or if you want to refine the ratio, you just take the revenue that is touched by R&D or touched by SG&A, but in most cases revenue is touched by these items. Most revenue is touched by these items, except for merchandise. Maybe there's probably not much R&D in merchandise expense, but either you don't have the disclosure or it's not a needle mover, and hence people typically don't adjust for that. But anyway, just as a side note for the analysts amongst the listeners. But bottom line is, what you can see in this forecast is that when we look at the latest available levels that are disclosed or inferable from the reported SEC numbers, you can see that so the dark blue line is SG&A in as of, and I should say this is actually the wrong labeling of this axis because it should be months, because I'm showing this metric on a trailing 12 months basis. Trailing 12 months means I'm taking the sum of the last 4 quarters SG&A spend and divided by the sum of the last 4 quarters of revenue, and this is kind of a way to smooth out sort of sequential quarterly fluctuations to avoid the noise introduced by seasonality, etc. It just enhances sort of the result that you can gain from this analysis. And long story short, when we do this as of December 2024, SG&A spend as percent of revenue decreased down to 38%. And I think this is hard to read here, but for R&D, the percent decreased to 32%. And if we compare these numbers with 2023, December year end, so this improved modestly from 39% for SG&A, so 39 to 38, and but R&D improved a lot from 45% of revenue down to just 32%. And then when we look at the forecast, and this is just pure coincidence, implies that by end of this year, 2025, both R&D and SG&A drop to 30%. Then there's some temporary sort of slowdown in improvement, and this is driven by the R2 launch. There will be incremental R&D spend associated with the launch. Same for R&D spend, and then you see a re-acceleration in improvement of efficiency ratios driven by the ramping R2 that translates into incremental revenue, while R&D and SG&A increase much slower than revenue, and hence the ratio is dropping. And you may note that here at the very end of this, let's call it improvement curve or efficiency gain curve, the rate of improvement is slowing, and this is simply because after 6 or 7 quarters of selling the R2 platform, you would expect a slowdown in growth because, again, we assume launch in 2Q 2026. So there is small volume which grows very, very quickly in relative terms, and you have kind of an S-curve adoption. But then, of course, as you have the vehicle on the market for, at that point, well over a year, you should see some slowdown in growth. And this is basically then slowing down your efficiency improvements, even though your, as you will see, or as you saw in this forecast, if we just quickly jump back to R&D spend, is not growing very much here, quarter over quarter, and then the SG&A also almost flattish. So the slowdown you see is a slowdown in the revenue growth. So with that, we then can jump to profit before tax. And as part of profit before tax, we'll be discussing non-operating items, which are also a non-negligible factor in Rivian's case. But this is something we'll do in the next part 11. So thank you very much for listening. See you in the next one. Thank you. Bye-bye.